Hello, everyone, again, and welcome to The Current. This is the North Central Region Water Network's, what we call our Speed Networking webinar series. This series is to introduce you to some great folks that are doing great things around the North Central region and nationally, and just a tease of some of the things that they're doing. My name is Rebecca Power. I am joining you from the University of Wisconsin-Madison, and I will be your moderator. Some of you may be new to the North Central Region Water Network. So we are a university-led, extension-led collaboration among 12 universities and our partners in 12 upper Midwestern states. Before we get into our topic for today, from all of us here at the North Central Region Water Network, we wish you, your families, and your loved ones all the best, and hoping that you are staying healthy and safe. As we've said over the past number of months, we are so grateful for all you are doing to care for our land and water, which is so important to our health as well. And sometimes those land and water issues are not top of mind right now. So thanks for all that you're doing to keep those systems as healthy and supportive as possible. With that, our topic today is market-based approaches to conservation. Last month, we covered 2 state-level approaches to nutrient management that had regulatory components. This month, we are excited to have with us 3 speakers that are moving the development of market-based approaches toward broader conservation forward. These approaches pay for ecosystem services that agricultural lands can provide, in addition to the other outputs that those lands provide. Before we introduce our speakers, a few notes about the way these sessions work. And you can see those on your screen. So please submit your questions for our presenters in the chat box. That chat box is accessible, should be accessible in the lower right-hand corner of your screen. There's a little purple tab there and a little speech bubble there. You can click on that, and that should give you access to the chat box. There will be, we'll keep those questions for a dedicated Q&A session after all 3 of our speakers are done. A phone-in option can be accessed if you're having any audio issues by opening up what we call the session menu, that little hamburger menu in the upper left-hand corner of your webinar screen, and selecting Use Your Phone for Audio. Great. So today's presenters, I'm very excited that we have with us Carolyn Wade, Program Director for the Ecosystem Services Market Consortium, David Lizax, Senior Fellow at the Croatan Institute, and Maggie Monast, Director for Working Lands at the Environmental Defense Fund. We follow our live tweeting of this webinar at North Central H2O and hashtag The Current, if any of you are interested in doing that or contributing to that feed. And without further ado, on to Carolyn Wade. So I'm not going to read her whole bio here, but you can see Carolyn's big smile there and read a little bit about her on the slide. She's got a wealth of experience, including with the Nature Conservancy and the Illinois Corn Growers Association, that she's bringing to this conversation. So welcome, Caroline, and take it away.
Yeah, well, thank you, Rebecca. It's great to be here. It's great to be back in the Midwest a little bit, at least virtually. Very impressive that you've pulled together so many people. So thanks for hosting and for the invitation. And thanks to all of you for participating. We've got 124 people on the call here. And it's really exciting to see so many of you interested in these sorts of topics, particularly since many of you are working directly with the producers. So I'm excited to be here. I think many of you know a good bit about ESMC. I'm working with several of you, but I think it's also going to be new to folks. So I am just going to do a high-level overview on this speed dating platform here. So next slide, please. The Ecosystem Services Market Consortium. Our mission is to advance ecosystem services markets that will incentivize farmers and ranchers to make management changes on their operations that will improve soil health systems that benefit not only the producers, but also in turn will benefit society by providing cleaner air and cleaner water. Next slide, please. We're going to accomplish that through an outcomes-based national scale ecosystem services market that was conceived and designed specifically for agriculture, which all of you know is a very different sort of industry than many of the others that these markets have been designed for in the past. So creating some unique challenges that we are specifically trying to overcome as we develop this new market, and really focused on the producers. So recognizing and rewarding the farmers and ranchers for the great impacts they're having by the improvements they're making, and really trying to bring as much value back to the producer as possible. Next slide, please. We'll do that by pulling together all of our members. So we are a consortium. We are made up of more than 60 members from all across the ag industry. We've got producer groups, we've got commodity aggregators, the food companies, nonprofits, NGOs, ag retailers, ag tech companies, and some university researchers. We also have some of the national agency representatives as as ex officio members. So really pulling from all across the industry to help us make decisions. These folks have also invested quite a bit in making this work happen and our research projects. So thank you to all of our members. If you go to the next slide, you'll also see that in addition to all of the member support, the member financial support, we have significant funding from organizations like Foundation for Food and Ag Research, as well as other foundations, and then NRCS, United Soybean Board, have all contributed as well. So we're really excited to have such great support in moving this work forward. Next slide, please. So how is ESMC different from other markets? There are a number of efforts going on in this space to develop markets for agriculture. So we like to point out some of the things that make us a little unique. First of all, we're a nonprofit organization, which really allows us to focus on that mission, allows us to focus on the impact, and then really meet our goal of bringing as much of that value back to the producer as possible. We're also very collaborative. We're a consortium, as I mentioned. So we're pulling together both the buyers and the sellers and all of the other stakeholders and bringing them together at the table to really figure out how we can design a market that's going to serve everybody's needs. So as I mentioned, we have a lot of support, investment in technology. That is going to be key to making this work, looking at advanced technologies for quantification and verification. How can we use technology to reduce the costs involved in generating the assets and really reduce the burden on the producer to provide all the information that's needed to do that? We are also systems-based and practice agnostic. So not prescribing any practices in particular, but knowing that producers need to make decisions that work best for their operations. And we then use science and focus on the outcomes to quantify the impacts and pay them for their performance. Our market's unique in that we can streamline the process for producers and pay them for soil carbon sequestration, greenhouse gas reductions, water quality, and water conservation all in one process. So that really aligns with our goals of maximizing the value back to producers and also making it easy for them. And this same system then allows us to generate credits for multiple markets. So it's kind of a tiered modular approach, which on the next slide you'll see in a little more detail. We have all of those different environmental assets, but we have those at 2 levels. So we have scope 1, which is geared more towards the offset and compliance markets. And then we have scope 3 credits, which are really more of the voluntary supply chain reporting that's needed. And this allows producers to sort of mix and match. They could do a scope 1 water quality compliance credit and then a scope 3 greenhouse gas carbon supply chain reporting credit. The system is the same for them, and then we can sell to multiple buyers. On the next slide is a quick overview of how our market works. Basically, producers provide information, or they can just import their information from other platforms. That information is combined with some other data sources. They're sent to multiple models to ask or to quantify multiple assets. And then that information is verified. The process is certified, and then those assets or credits are generated and sold to the buyers, and then the producers get paid for what impact that they have had. On the next slide, you'll see, maybe you've seen that we also have the ESMRC, which is the Ecosystem Services Market Research Consortium. And really, this project is preparing for launch. So doing all of the research and development, demonstration and deployment that we will need, looking at more of the high-tech and cost-effective means to get there. So we have research goals that'll take us through to our launch in 2022. And it is looking at all of the aspects of our program, really from the protocols to the quantification models, to the process of generating and selling those credits. We're building a significant technology platform to do that, you know, along with the certification and verification that goes along with that. So beyond 2022, once we launch, we plan to scale up throughout the whole US and then add some additional assets. We're looking at things like biodiversity and habitat conservation. So we have kind of a long-term goal as well. If you go to the next slide, you'll see where we currently have pilot projects that have launched and several in planning. So, you know, very heavy in the Midwest area. We started in the Southern Great Plains and have moved on to the corn and soy belt where there's a lot of opportunity. Also have completed protocols in the Great Lakes, the Northern Great Plains, and now we are getting into Pacific Northwest and California. And if you go to the next slide, a little more detail on some of our research. So the ESMRC is actually made up of 4 working groups and half a dozen or so strike teams. So member representatives join along with some external science advisors, and they really focus on developing research projects to help us meet some of those critical questions. So the 4 groups are focused on greenhouse gas quantification, water quality and water quantity quantification, building out that MRV platform, so the monitoring, reporting, and verification platform. And then we have another group that's looking at soil carbon research. And they break off, and they've got a number of strike teams that really dive in a little bit deeper on things like soil sampling, soil stratification. We're building an app to do that so that it's a little more streamlined. Looking at some innovative soil carbon measurement tools, and also some new ideas on how to quantify the N2O as part of the greenhouse gas modeling. So really trying to refine and test all those models, making sure that we balance sort of the robust science with just the scalability. And throughout this whole process, we'll be pursuing certification of the program and the protocols, so that the assets are certified at the end of the process. So all of those things are going to be tested out within the next several years before our formal launch in 2022. Our main goals being bringing down the costs. Again, that gets to more value for the producer, knowing we have to meet their needs as well as what the buyers are asking for their reporting requirements, and then looking at how we're going to implement this at scale across the whole US. So that was a pretty quick overview of what we're trying to do, and I'll look forward to some of your questions at the end. But thank you again for the opportunity.
Thanks, Caroline. Appreciate it so much. And yeah, we know these are some pretty complex topics to focus in on 10 minutes. So this is a tease, and we hope you will contact our presenters with any additional questions that you have if we can't get everything in today. So on to our next speaker, David Lazax. So David, again, is a senior fellow at the Cant Institute, and he's going to be talking to us about aligning capital to build soil wealth. So thank you, David, and the slides are all yours.
Thank you so much, Rebecca. Thank you for having me today with the Current. First time here, and hope the Current doesn't sweep us away. I'll be going through kind of, as requested, rapid fire information here. The last slide, I'll have links to all of the kind of initiatives and projects that we're talking about, so don't feel that you have to scribble everything down in the interim. And for those of you not familiar with the Croton Institute, we're a North Carolina-based nonprofit whose mission is to harness the power of investment for social good and ecological resilience. I myself sit here in Madison, Wisconsin, though, with many colleagues who I also see on the call. There we go. So most of our work really does have a market focus, whether we're talking about how investment dollars move or building markets for for moving of using finance for a tool for good. And my focus is really on the agricultural part of this. And some work that was done last year around kind of true cost accounting for food for the first time at a global scale showed that the hidden costs of global food and land use systems actually exceeded the market value of these systems, $12 trillion of cost and $10 trillion of value. And this is of today's agricultural system, and really seeing that being dispersed over health, environmental, and economic categories. But we know that there's actually a way to identify pathways to reduce those costs and increase the value from our agricultural and food and fiber systems. And a summary of some of those public and private benefits delivered by some of these agricultural systems, whether we call them agroecological or regenerative or sustainable or organic, kind of under that kind of broad array of agricultural systems, we do see that we can improve many of these characteristics. Now, how we do that, where do we see finance and support and policy all aligning to do that, is where the rubber meets the road in many cases. And with that, we also, a colleague of mine, Natalie Reitman-White, formerly of the Organically Grown Company, said, or the first time I heard it was, you can't fix a broken food system with a broken finance system. And so if we know we have all of these negative environmental, social, and health externalities, many of the reasons we have those is for poor accounting systems, improper ways of really looking at the holistic nature of these systems. But so where our work fits in and where our partners really begin to address this is, how do we use finance as a tool for good to begin to remediate some of these challenges that we have? And in some of our work that we published last year in a report called Soil Wealth, Investing in Regenerative Agriculture Across Asset Classes, we began to map these flows of capital across the agricultural system, starting in the US, looking at the different holders of capital, starting with institutional investors and asset owners, following that capital through to how it's deployed through these asset classes, like loans or real estate or bank finance, and then how it's deployed out through the agricultural value chains and the many pieces of that you're all very familiar with. And then, of course, what's the role of catalytic capital, whether that be grants or from endowments and philanthropies, to really help to catalyze change in these systems and bring about food and agricultural systems that provide these greater suites of benefits. And so with that, kind of this trajectory of how we get to improved outcomes across these systems to improve our water, improve our land, decrease carbon in the atmosphere, I'll tell you in just some short snippets of projects that we're working on. The first one is through a grant through the USDA's Conservation Innovation Grant Program, coming off of our soil wealth report. We're looking at a new place-based approach that we're calling regenerative organic agricultural districts that would establish special purpose soil wealth improvement districts that become magnets for regenerative agriculture investments. We're about 4 months into this 2-year project that is going to use this place-based approach, similar to, if some of you might be familiar with other place-based land secured finance, like property assessed clean energy on the renewable energy side, that would take these districts, flow capital into them on a much longer term scale than some current financial vehicles allow, and then both provide returns from a financial return on investment, but also from that impact perspective on improving soil health and community wealth. Looking at other systems that we're collaborating on, including ones in the Midwest led by the Savannah Institute on moving toward more diversified perennial systems. And as you see here, the representation of kind of our status quo system of today and how agroforestry or tree and perennial dominated systems might help to not only capture nutrients, stabilize soil, and reduce pesticide use. And it's through not only innovative financial mechanisms that might help to finance increased number of trees and other perennials on the system, but it's also from a market perspective, building markets around some of the outputs. And so as they term hazelnuts as soy on trees and chestnuts as maize on trees, is that there's already huge markets for some of these crops and commodities. And many of that currently we import either into the Midwest or from other regions or internationally. But given our soils, our climate, it's definitely possible to kind of rehome some of these value chains and the production and build markets so that producers and farmers have access to these markets and are able to sell into them. Grassland 2.0 is another project that we're involved in. There's some of my colleagues, including Rebecca Power, who is moderating the webinar, who is part of this project. And Grassland 2.0, another USDA sponsored project that's looking at grasslands, perennial grasslands in the Midwest as a response to 3 major problems. One being farmer profitability, environmental degradation, and community decline. And with that, what Grassland 2.0 and the team who is behind this is looking to be not only the catalyst behind these agroecological transformations between our current mostly annual dominated system and what we envision as a team with our sets of stakeholders as this future or perennially dominated system. And working within this team over the course of 5 years with institutions, through policy, financial mechanisms that our team is specifically taking the lead on, and then looking at both these value chains from the consumer side, and also, of course, farmers. How do we make sure that these perennially dominated grassland systems are profitable for farmers, and farmers have a space and have power and have voice and agency in all of that. So really exciting to get that off. It's been kind of formally launched just over the last couple of weeks with some articles in I think in WPR and Civil Eats and Ag Funder News was covered in all of this week. And finally, this last example on regional grain system development. And over the last 50 years or so, we've seen a real consolidation in not only our grain system and the number of and the diversification of some of these systems, but also really across this entire value chain. And here in the Midwest and in other places across the continent, we're really seeing the revitalization of these regional grain systems, starting with seeds and seed breedings, farmers, processors, millers, bakers, and of course the consumer. And in this, where we're plugging into some of these efforts is identifying where there's opportunities for capital deployment and making sure that the appropriate types of capital are getting to these different actors within these diverse value chains, and that we're able to support them with this capital as we begin to diversify these value chains and providing both the economic benefits, health benefits across these landscapes that we're looking at. So everything from production loans and transition finance to new processing infrastructure. We have seed breeding that's going on, brand development closer to kind of to the consumer, and all of this is part of the reimagining of what some of these grain and bean value chains look like. So rapid fire. That was about almost 10 minutes here, and as I promised, here are a number of links, including the one that I saw Rebecca show to the grasslandag.org. Of all these exciting different initiatives that we're working on, all to use finance and market building approaches to bring forward a more sustainable and regenerative agricultural system. Thank you.
Thank you, David. And you were reading my mind, and as I was just thinking back, it's so amazing to see all of these different approaches proliferating, and some great questions are having in the chat. So please, thank you again, David, and please contribute any other questions that you have for Caroline and David in the chat. And now, getting on to our final presentation from Maggie Monast. And Maggie is the Director of Working Lands for the Environmental Defense Fund, and she's going to be talking to us also about financing resilient agriculture from her perspective and some of the work that she's been doing recently. So thank you, Maggie, and take it away.
Thank you, and thank you for having me. So, you know, as you said, Maggie Monast with Environmental Defense Fund, which, if anybody's not familiar, we're an international environmental nonprofit organization. And today I'm going to be focusing on a recent report that's one portion of our agricultural finance work, really focused on agricultural lenders. So today I'm going to be talking about climate risk to both farmers and their finance providers, lenders, and how they can both assess that risk and then work together to finance more resilient agriculture. So first, I want to quickly acknowledge some of the contributors to this report, especially Dick Whitman, who's a farmer on our Farmer Advisory Board. He's been working with us for over 20 years and previously had a career in farm credit and also on his family farm in Idaho. We also had several ag lenders who contributed to this, along with the Agree Economic and Environmental Risk Coalition, the Nature Conservancy, agricultural accounting firm Keiko Isom, and Longrose Consulting. So I think everybody on this call is probably familiar with some of the impacts of climate change on agriculture. And we've seen this both in the major events of this year with the derecho in Iowa, the flooding of last year. I live in North Carolina and have seen multiple hurricanes hit our agricultural region in the coastal plain over the past several years. But then also just the more variability is something that I've heard from a lot of the farmers and agricultural advisors that I work with is becoming really challenging for farmers to manage. And those impacts are obviously felt by farmers, but then they also flow through to their financial partners, including agricultural lenders. So I like this quote by the CEO of CoBank, especially right after an election. Concerns about climate change are now a permanent part of the operating environment for rural America, and they're here to stay, regardless of the political party in charge. And so for an example of these risks, we can look last year at the 2019 floods. We saw 70% of borrowers were at least moderately affected in the Midwest region. And then there was the highest rate of major and severe repayment problems in 20 years. So you can see how these risks to farmers then flow through to their lenders. And part of the challenge here is that agricultural banks tend to be very focused on agriculture. And so you can see by this map that there's a high concentration of banks that have at least a quarter or more of their portfolio concentrated in agriculture. So the types of risks that they face, one are physical risks. You know, if a farmer can't repay their loan, that presents a risk to the lender, especially if large numbers of farmers are having difficulty with that. And then also correlated risks. So many of these banks finance not just the farmers, but then also associated agricultural businesses in a region, especially when we're talking about community banks. They may be financing the local grain processor or other farming businesses. And all of those are affected by a major weather event like the floods that we saw last year. Now, you may be thinking, well, if we're talking about climate risk, why are we talking about lending and not crop insurance? And crop insurance is a really important risk management tool. But if you look at this graph, you can see this is the source of the different over the past 10 years. And you can see that water is really driving these claims, either drought, so that 2012 drought stands up really high there over on the left, and also floods. So you can see 2019 has a big flood segment in there. And as you can see, you know, the USDA Economic Research Service did a study, and they found that both the extent that the climate changes and also farmer adaptation really matter in terms of the types of crop insurance costs we're going to see. And so if there's you know, minimal adaptation and minimal climate change, the cost of crop insurance could not increase hardly at all in the second half of the century. But if there's high levels of emissions and associated climate change and little farmer adaptation, it could increase by about 40%. And so that's a risk. But then even beyond the cost of the program itself, it's also important to note that crop insurance is insufficient to protect farmers and their lenders from the impacts of climate change. One, because crop insurance was never designed to make farmers whole. You know, the maximum payment rate is around 85%. And so especially if farmers are hit by recurring disasters, the strength of their financial position can degrade over time. Second, you know, we know that most coverage is for a few grain crops, which is good if you're sitting in the Midwest, but if you look at the nation as a whole, there are serious gaps in insurance coverage. And then also, you know, crop insurance, of course, doesn't help with the correlated risks that I mentioned earlier. You know, it matters if a crop isn't produced, and insurance doesn't protect farmers, lenders, or local rural economies against those. So some of our work looks at the role of climate resilient agriculture in mitigating some of these risks. And we focused on three main strategies that are applicable, I think, across the country, though they would be applied in different ways. You know, so one, building soil health through practices like cover crops and no-till, trying to make soil spongier so they can better absorb water in times of excess moisture, and also hold on to it in times of insufficient moisture. Managing water effectively, which of course would look different if you're in California or if you're in a place like where I live, where we're seeing more frequent flashy storms. And then diversifying crop rotations and integrating livestock. And that last one is helpful both in terms of the environmental resilience of the farming system. It's also helpful in terms of just diversifying the farmer's income portfolio. So if there's something takes out one crop, you know, their other crops are still something they can fall back on. And so we have done a lot of work with agricultural accountants and other organizations that are working to quantify through farm budget analysis the financial case for climate resilient agriculture. And we found through those analyses that there's, you know, a few basic benefits. One, reducing production costs, so the ability to reduce fuel and labor in the case of no-till, the ability to reduce fertilizer and herbicide costs as soil health improves through cover crops and inputs can be reduced. Then a big benefit over time is increasing the stability of crop yields. And last, as I mentioned, diversifying revenue sources so the farm can be more financially stable over time. But we have to acknowledge that there are also important barriers, and especially in a tough farm economy, those barriers can be hard to overcome. So some of them include the short-term transition costs, the risk, as well as just the farmer's learning and time. And it's important to acknowledge that the financial products that farmers currently use, like their operating loans, don't acknowledge those challenges. They don't take into account the benefit of resilient agriculture over time. And they also don't help farmers overcome the short-term difficulties. That's, for a few reasons. One, just the annual nature of most operating loans. You're just looking year by year rather than over the long term. And also the focus on loan repayment rather than long-term profitability. And I've worked with several ag lenders who see this as a real challenge. That short-sighted view is preventing them from supporting longer-term profitable operations. So the report had a few high-level recommendations and then some, a lot of detail involved in this. But one is just for the agricultural lending sector to assess climate risk. Right now, by and large, this is not happening, and the lending sector is being left behind by more of the global financial sectors. There have been a lot of advances in figuring out different tools and ways to assess the risk of climate change to the stability of financial institutions, and agricultural lenders should be participating in that. Second is better understanding the role of resilient agriculture in managing climate risk, both for farmers as well as for their finance providers. And this is an area where I think there's a great opportunity for extension to play a role. In expanding the type of farm budget analysis that I was mentioning. There are a lot of your universities have farm business centers, and I think those are great partners in looking more closely at how conservation adoption affects farm budgets over time, both what are the barriers and what are the benefits. And then last is for lenders to design lending programs or products that support farmers in building climate resilience. And while lenders can't tell farmers that they have to do X, Y, or Z, that would be an inappropriate use of the lender's power. They can, and there are many examples of lenders starting new programs or products that help farmers navigate different types of transitions. So there's the long-standing Farm Credit Young Beginning and Small Farmer program, and other lenders have those types of programs as well. And there are more recent examples of organic transition loans helping farmers overcome that 3-year gap between starting the organic practices and receiving the premium. So we think that there's a good argument to be made that something similar for soil health practices would work really well too. So that's it. You can see the website for this report on ag lending. We also have another website, edf.org/farm-finance, where you can find our farm budget analyses and all of our other reports. Thank you very much.
Thank you, Maggie, and thanks, Caroline and David. And Maggie, if you would be able to pop those URLs in the chat to make it easy for folks to get to, that would be awesome. I'm sure there are people that would want to get to those quickly, so thank you. And I'm going to go right to questions, and glad to see Ben Gramig with us. A couple good questions from Ben. The first one was for Caroline, related to Caroline's presentation. He says, quote, practice agnostic, related to the practice agnostic nature of the ecosystem services market's effort. But I think it's a question about are all practices eligible to generate ecosystem service credits, and maybe what kinds of criteria would you use to determine whether practices are eligible for credits?
Yep. So great question. Hi, Ben. So first off, we are currently using the DNDC model for our soil carbon and greenhouse gas quantification, and then we are using the APEX model for our water quality modeling. So basically, any practice where we have enough calibration and validation data to include it in those models would qualify, right? So anything that can contribute to how that model does all its work to determine the outcome is fair game. So, for example, as we've moved into the Midwest from the Southern Great Plains, we have acknowledged that edge of field practices are super important, especially in some of the tile drained areas. So we specifically are searching for the data sets needed to incorporate some of those edge of field practices into the APEX model. So that's actually a research project that's happening through one of our working groups. So that's how the practices then become incorporated. So, in the protocols, it's limited to whatever we have the science to support, basically.
Thank you, Caroline. Okay. Next question from one of our guests, and a compliment, great talk for when Caroline was presenting. How might these credits relate to invasive species? Is there anything you're doing? We certainly there are a number of challenges that invasive species can pose, and water quality certainly is one of those, and the impact of invasive species on water quality. So anything related to invasive species in your work right now?
Yeah, so we are really just on the cusp of looking at things like biodiversity, habitat conservation. So that will most likely be post-launch, so post-2022, once we get the soil carbon, greenhouse gases, water quality, water quantity really nailed down. Then we'll come back and start to look at some of those things. So no, we don't currently have anything that is specific to invasive species.
Okay, thank you. Adam, hello, Adam Keel. Adam asks, and again, this is for Caroline, how do you see the public investments in the ecosystem services work that you're doing, and the research as part of that work benefiting others working on ecosystem service markets?
Yeah, that is an excellent question too. And hi, Adam. So because we are funded, as you said, through some public investments, and there's a strong research component, all of what we're learning and our experiences and the development of the protocols and the program will all be reported out, so that is a requirement of some of our grants. So I feel like, that is going to be great information for really anybody working in this space. We are committed to being transparent, and once those results are final, we will certainly be sharing a lot of that information. And I think in the meantime, some of the work we have done is actually informing other efforts that are ongoing. And really, we see that as a good thing, right? Our mission is to, really catalyze adoption of conservation practices. So any efforts in that direction we see as a positive. Specifically, we have one project that has come out of one of our working groups where we have identified this need for a better repository for data sources. So we're trying to figure out how we can invest some of our funds in sort of catalyzing the development of those data repositories. So that will help us with our modeling work. We need better data for DNDC and APEX, but that same information could be used for other models that are being used or other programs that are developing. Practice adoption rates, that's another area where we've identified that we need the information. If we can help invest in that, that's going to be valuable for many programs, not just market programs.
Great, thank you, Caroline. And going down the list, questions for Caroline. Currently, Cindy, hello, Cindy asks, currently, is the system arranged to benefit the producers making changes, or to incentivize changes to best management practices, or does it also include a system for farmers and ranchers who are already implementing practices that would benefit, would provide ecosystem services?
Yeah, another great question. That is something we get a lot, specifically from producers and producer groups. And that is one of those challenges that has not been addressed in previous markets. So we are really advocating for the inclusion of early adopters in the system because of the market demand is a little lower for that sort of asset. There may be a discount on the amount that the asset is worth. But it is something that we are really trying to change in how current protocols are reviewed and approved. So we are a strong advocate for early adopters, understanding that those folks are going to be the greatest champions for pulling in those middle adopters or those late adopters. So we really see that as a key audience to have on board and promoting our market. The other thing that we're doing is using the prevailing practice as a baseline. So that's something else that we're advocating for. Basically saying if a practice is not common in your area, then that should be considered something additional, even if you are already using it.
Great, thank you, Caroline. Okay, a question from Brian Adams, who's one of our behind the scenes technical support folks for this webinar. So Brian asks, is there a viable market for hickory nuts? And I think that could go to a number of our presenters. So I'll just, I don't know if David, that one might be a good one for you.
Sure. Yeah. From the perspective of some of the crops that Savannah Institute is working on bringing to market, it's not one that's high on the list. They're mostly focused on hazelnuts, chestnuts, elderberries, currants, and some others in there. But not to say that hickory nuts don't belong on the next version of the list.
Great. Thank you, David. Jennifer asks, are lenders potentially going to, or are they looking for resilient actions similar to bonding agencies looking at municipal actions for resilience, meaning tying rates to action? So Maggie, maybe we can start with you on that question.
Yeah, absolutely. And thanks, Jennifer. I would say that's a potential way that this could go, but lenders are not there yet. And part of this is a data question. You know, right now they don't collect data in a way that would allow them to see these benefits. So again, I think, you know, since lenders often look to university research for direction, there's a huge role for university researchers in showing, connecting the dots for them between farm financial performance, conservation adoption, and resilience. So we're not there yet. I think in order for that to happen, there may be a regulatory change that would need to be made. But things that can happen now are, you know, lenders can collaborate more closely with some of their farmer borrowers who are trying some of these practices and work with them to understand those financial impacts, and then more kind of opt-in financial products that would make it easier for farmers to do that. And they could do that on their own. They could also do that in collaboration with other forms of capital like supply chain companies, like philanthropy, government. So there are some options that lenders could use to innovate in the short term as we hopefully make progress on some of those data gaps.
Great, thank you, Maggie. And I know I'm interested in following up with you on some of the ideas that you have for university research and extension contributions that you've hinted at, but this is one of those speed networking things where I'm looking forward to following up with you, and I'm guessing there are others other participants in the webinar that would be interested in that too. So Ben has another question, Ben Grammig. Including some of the, quote, climate resilient practices in an expanded conservation compliance provision seems important. Statement, kind of a statement question, seems important for solvency of FCIC and the need not to increase the subsidy rate above the current average of 60 cents per dollar of coverage. You can't tell that Ben's an ag economist, can you? So I don't know, does any of you want to comment on Ben's observation there?
Yeah, this is Maggie. So, As you know, and thanks, Ben, for your comment, I think that's a really interesting take. As you know, crop insurance and lending are very closely connected and have kind of a symbiotic relationship. Crop insurance coverage allows lenders to keep their loan rates low. And so any progress that we can make in crop insurance will also benefit lending. Plus, there's just the inherent benefits of improving crop insurance assessment of and inclusion of resilient practices. I was on got to attend a call with the Risk Management Agency's chief actuary, Tom Worth, not long ago. And they say, right now, kind of the benefits of these practices are included. Basically, the argument is kind of it all comes out in the wash. All the data that they collect, eventually that will be reflected. But he noted that they're not explicitly included, and that is an area that he's interested in learning more about. So again, I think there's a really good opportunity there for some more targeted research. And the AGREE Economic and Environmental Risk Coalition, of which we're a part, recently was able to come to an agreement with RMA about some researcher access to some of their data. And I think that is an area where EDF is really pushing, is to make sure that researchers can analyze data in a way that can influence RMA policy.
Perfect. Thanks, Maggie, and thanks, Ben, for that additional comment there. Okay, let's see. And thank you, Matt, for clarifying your question there on invasive species. I think we've covered that, but you can let us know if we haven't. And on to Naveen. Hello, Naveen. Maggie, you presented a graph of indemnity payments. However, those payments also include prevent planting payments. We know prevent planting payments do not necessarily mean the farmer did not plant the crop, but they did not plant the crop in the usual planting window. So the reference to indemnity payments do not capture the risk nature of the enterprise entirely. So just a comment there from Naveen and thoughts from you, Maggie, on that.
Yeah, that's a really good point, and that goes back to that AGREE effort that I just mentioned, and Ben seems to be aware of too, to really look at data from that 2019 prevent plant year and see what more we can learn about the impact of conservation adoption on that really interesting data year. So I agree. I'll take a look back at that chart, but I also think that year deserves a closer look.
Perfect, thank you. Great exchange here. Lots of expertise in the audience, and glad the audience is participating. So thank you. Colin asks, for new crops and cropping systems with the potential to improve soil health and mitigate climate change, how do we best de-risk these crops during their critical pilot phase? And he says something about his experience with lenders and insurance. They want multiple years of location-specific commercial yield and economic performance data. Creative models for sharing risk until lending and insurance partners come online feels important, so growers aren't bearing all those risks. So I don't know, Maggie, maybe you want to start?
Well, I also think we can get David in here on this one.
Okay. Sure. Yeah, I can speak to that as well. And I think that where we're seeing some of the existing financial partners, the farm credit and commercial banks that are used to financially supporting, the majority of agriculture, versus some of these emerging systems, and that's where there's philanthropic and private funds that are working to not only financially support the growth of those systems, but also to generate the data that I think these larger lending and insurance partners need in order to really get comfortable with it. So it's firms like Iroquois Valley Farms, Mad Agriculture, Replant Capital that have all recently made headlines for their lending and investing in the sector. And again, those funds are and different approaches might not have access to the capital markets as some of these larger banks do, but it's family offices, philanthropy, impact investors that want to use their capital in a way that's going to create financial return on investment in addition to some of the social and environmental returns as well.
Yeah, I would agree, and also add that in our Financing Resilient Ag report, we have a section on loan support, which is basically some of these pilot loans with lenders. And there are multiple different approaches to that, and it can be everything from, you know, production contracts to subordinated debt or loan guarantees, even things like technical support reduce risk because the farmer is supported in making the change. So I think there are a lot of options, and I would say the challenge is just you know, pulling all the pieces together in a way that it can be tested and scaled.
Yeah, thanks, David and Maggie. And I know Colin, I know David and Maggie both have very specific examples, more specifics than we were able to get into today. So if you have you know, specific needs yourself, I'm sure they would have suggestions for you if you follow up with them. And a question from Laura Payne, who's also a part of Grassland 2.0 that David was mentioning earlier. And I think we have Randy Jackson on the line too, who's the lead for Grassland 2.0. So Laura's question: a lot of this work seems to be focused on annual cropland right now. Do the models include documentation for well-managed pasture, both warm and cool season? So I'll throw that out to all of you who'd like to start.
Yeah, this is Caroline. I can respond to that. We actually do include rangeland in both our protocols and in our pilots and the models. So our first pilot was actually a grazing project in the Southern Great Plains, and we've expanded that a little. We're working with the National Cattlemen's Beef Association on a new pilot in Kansas. We have some things brewing in the Northern Great Plains, and then we've just launched a project with Sustainable Northwest in Oregon that is also a grazing project. So, you know, still trying to figure out what the opportunity is there under, you know, improved grazing systems for carbon sequestration. But we have data to incorporate that into the DNDC and the APEX models. So that is underway in our pilot. So stay tuned.
Okay, any other follow-up on that from Maggie or David?
I think from the financial side, it's especially the banks that are financing this area, important for them to have the appropriate underwriting tools. And again, going back to the data that, you know, they need to become comfortable lending in these areas. So it's going to take these early scale pilots and other approaches to kind of build the data that show that these systems are profitable, that they're more resilient, and you know, right now we have a lot of anecdotal evidence, and probably a lot of that Laura was part of generating that data, but now it's time to kind of institutionalize it and make sure that it becomes actionable in the very near term.
Great. Okay, well, that is a nice note to leave it on. And just, again, thank you so much to all of our presenters, Carolyn Wade, David Lazax, and Maggie Monast. And you please, you know, feel free to follow up with them, as we said, if you have other questions or are looking for more information. You can, we really appreciate your participation as well as just listening in. I know sometimes it's easy just to sit back and multitask on these webinars, but it's great to have your input in the conversation. You can visit our website, northcentralwater.org, to access the recording of this webinar. Please share it with others that you might be interested and weren't able to attend today on the live session. Also note we have an upcoming webinar that's put on by our North Central Climate Collaborative team, NC3, Drought Decision Calendars for Specialty Crops, and that will be Monday, December 14th at 1 p.m. Central Time, and you can register at northcentralclimate.org. Thank you so much for your time today. Stay safe, stay healthy, and hope to see you again, hear you again on another edition of The Current.